Welcome to the Deep Dive. Today, we're immersing ourselves in AMETEK's Q3 2025 earnings call. That came out October 30th.
Right.
We've got the details here, and it looks like, well, a really decisive quarter for them, high conviction stuff.
Yeah, that's right. And this call, I think, gives some crucial context for anyone tracking the industrial space. The big question for us today, and for you listening, is really, can AMETEK keep up this, high tempo operationally and manage the margins while they're also absorbing these recent, pretty complex M&A deals?
Yeah.
So we're going to unpack the numbers that drove that double-digit growth and, importantly, the big bump to their full-year guidance.
Okay, let's jump right in with the snapshot then, because like you said, it was a classic beat and raise from AME. Adjusted earnings per share came in at $1.89.
Yeah. That
significantly beat the street consensus, which was around $1.76, right?
That's it. A solid 7% beat on the bottom line.
And that beat was built on, well, pretty strong top-line performance, too. Revenue hit $1.89 billion. That's up 11% year over year.
And management was quick to frame that,
Yeah.
They immediately called out double-digit growth across sales, orders, operating profit, and diluted EPS.
The whole package.
Exactly. The kind of clean print the market loves. And you saw that in the reaction, right? Strong trading volume confirmed the positive sentiment pretty much straight away.
Okay, so headlines look good. Let's pivot now and dig into the engine room, because the margins and the execution seem to be where AMETEK really stood out this quarter. The reported GAAP operating margin was 25.8%.
Right, but I think the real story is in the core operational strength. If you strip out the impact of those recent acquisitions, which often drag margins down initially.
Sure, integration costs and all that.
Exactly. The core margin was an outstanding 27%.
27%. Okay, let's pause there for a second. That's impressive. What does that 90 basis point expansion over last year really tell us? Is it just cutting costs or something more?
Well, it signals really strong pricing power and operational gearing. Basically, they can grow faster than their costs are growing. In this environment, where, a lot of industrials are wrestling with inflation, labor costs, materials, getting 90 basis points of core expansion. That shows they're passing on costs successfully and really benefiting from scale in their niche tech segments. Yeah. It's a key sign of, business quality.
And competitive advantage.
Definitely.
And that profitability then feeds into their visibility, their financial strength going forward. They reported record orders, didn't they? $1.97 billion.
Yep, up 13% overall. And importantly, organic orders were up a very healthy 7%.
So demand is still strong underneath it all.
Right. And that order book builds into a record backlog, $3.54 billion. Yeah. That gives them a significant kind of de-risked revenue runway well into next year.
Okay, and connecting that operational strength back to the financials, this is why they seem so comfortable with the M&A strategy, yeah.
Exactly. Look at the free cash flow conversion. It was really strong, 113% for the quarter.
So they're converting more than every dollar of net income into actual cash.
Precisely.
Yeah.
And you couple that with a conservative balance sheet, net debt to EBITDA is only 0.9 times. Very comfortable. They just have tremendous capacity. Management confirmed they still got over $2 billion ready for strategic M&A.
Wow.
So that whole growth by acquisition strategy, fully funded without messing up their financial ratios.
Right. So they've got the cash for deals, but they're also investing internally, aren't they? Management mentioned an extra $90 million this year just for organic growth stuff, R&D, sales, digital marketing.
Yeah, and you're starting to see the payoff from that R&D focus. They highlighted a few things. Vertec Vision's new AI-powered camera system for quality control.
Okay, interesting application.
Yeah, reducing waste for manufacturers.
Yeah.
And then NSI Technologies has this vector digital receiver that's critical stuff for next-gen comms systems, sensors often used in defense and space.
High-tech stuff?
Very high-tech. And Rollins, another one of their businesses, won a MedTech Breakthrough Award for its responder platform in healthcare. So, yeah, that investment is definitely leading to product wins.
Okay, let's shift gears then to the operational core, the segments. Because we saw a pretty big difference between the two main groups, EMG and EIG. The Electromechanical Group, EMG, that was the clear star this quarter, right?
Yeah.
Showed some serious acceleration.
Oh, the EMG story is fantastic. Sales up 13% year over year. And get this, 12% of that was organic growth.
Wow, okay.
And it wasn't just volume, the margins. EMG operating margins hit 25.4%. That's a sharp 250 basis point jump from last year.
Yeah.
I mean, that kind of expansion in electromechanical, that's pretty rare.
So what's behind that EMG acceleration? Is it just the general industrial environment picking up?
Management pointed to, well, two main things. First, just broad-based strength, but really fueled by getting the Paragon Medical acquisition integrated successfully.
Right. Paragon, they make high-precision stuff for the medical industry, orthopedics mainly.
That's it. Components, instruments. And second, management thinks that long kind of painful destocking cycle we saw affecting OEMs, it seems to finally be ending. So orders are rebounding strongly. Paragon specifically is seeing, quote, outstanding double-digit plus orders growth.
Okay, the Paragon integration sounds like a big win, but management threw out a very ambitious target there. They said Paragon's margins are already in line with AMETEK averages, but they're aiming for 35% plus EBITDA margins once the restructuring's done. That seems high for manufacturing. What are the risks there?
That is the crucial question, isn't it? It really speaks to their belief in, operational leverage and their own proprietary processes. Getting to 35% is a huge structural shift. They're betting heavily on deep integration, using AMETEK's buying power, standardizing manufacturing.
A lot has to go right.
Exactly. The risk is mainly execution. Any delays in the restructuring, any unforeseen pushback from customers, that could slow down that re-rating. But if they hit that number, it fundamentally lifts the whole profile of the EMG segment.
And justifies a premium valuation, perhaps.
Potentially, yes.
Okay. Meanwhile, the other half of the business, Electronic Instruments Group, EIG, it grew 10%, but that was mostly acquisitions, right? Organic was basically flat.
That's the divergence, yeah. EIG, organic sales flat, M&A added 9 points of growth. But the profitability stayed very high. Operating margins were 30.4%, even excluding the acquisition impact.
Still very strong margins.
Absolutely. This segment is more focused strategically on building out its metrology platform, high-tech measurement, testing, 3D imaging.
Right, through deals like FARO and Kern.
Exactly. FARO does the 3D measurement imaging. Kern's more analytical measurement.
Yeah.
And management said the FARO integration is on track, hitting its sales and profit targets for the quarter.
Okay, so EIG is kind of in that strategic build-out phase, while EMG is really enjoying the fruits of that operational leverage right now.
That's a good way to put it.
So given all this momentum, especially in EMG, what did the updated guidance look like? They raised it, you said.
They did, yeah. As you'd expect. The full-year outlook was bumped up pretty substantially. Full-year adjusted EPS now expected between $7.32 and $7.37.
Okay, up from what, $7.06 to $7.20 before?
That's right. A meaningful hike. And the Q4 guide suggests sales up around 10% year over year, with adjusted EPS expected between $1.90 and $1.95. So yeah, the momentum is clearly expected to carry through to year end.
All right, let's get a bit more granular then on the end markets that are going to fuel that Q4. Management gave a bit of a tour. Where are they seeing the really strong, resilient demand?
Aerospace and defense is still incredibly robust. They saw low double-digit organic sales growth there in Q3. And it's balanced, across commercial planes, the aftermarket defense programs.
So less cyclical exposure maybe than pure manufacturing.
Exactly. It speaks to their kind of mission-critical role in those sectors.
And the other big area, power and industrial, that also showed mid-single-digit organic growth. And there's that interesting detail about its connection to the AI boom.
Yeah, that's where it gets really interesting, I think. They are directly benefiting from demand tied to grid modernization, electrification, and crucially, that massive power build-out needed for AI data centers.
Right.
They specifically highlighted products like their IntelliPower UPS systems, uninterruptible power supplies.
Essential stuff for microgrids, data centers.
Absolutely essential. As all these tech giants race to build more AI capacity, AMETEK is supplying critical infrastructure components sitting right next to those huge power draws. It's sort of a subtle but, I think, powerful hidden growth driver.
Interesting. Okay, what about geographically? Europe was surprisingly strong, you said, up low double digits.
Yeah, led by automation and medtech businesses over there. U.S. stayed solid. But, every global company faces headwinds somewhere.
Where did AMETEK see the challenges?
China.
China was the main drag, yeah. Asia sales overall were down mid-single digits, and that was attributed mostly to China. Ongoing trade issues, tariff negotiations causing customers to delay decisions, just slower decision-making on big capital buys. Sounds familiar. We hear that a lot right now.
It aligns with many other multinational reports, yeah. They also mentioned the process market segment, that's complex capital equipment, saw slightly down organic sales in Q3. Again, customers just delaying big investment decisions.
But management did signal that visibility in process is getting better, suggesting maybe 2026 could be strong. So even though Q3 was slow, The order trends might be hinting at an inflection point.
Exactly. It shows they're managing the cycles pretty effectively, doesn't it?
Oh,
They seem to understand that when CapEx slows down, they can lean on the profitability of their defense and medical businesses, which are less discretionary,
right.
and use that cash flow, that financial capacity, for M&A. So they potentially emerge from any slowdown even stronger.
Okay, so if we tie this whole operational story together, the big picture thesis seems clear. It's M&A compounding growth, combined with really strong execution, driving potential for a re-rating.
Yeah, which definitely raises the question, if you're an experienced investor listening, how do you think about playing this momentum? So I guess it's time for our not financial advice segment.
Ah, yes, the outrageous but plausible trade idea. Let's hear it. Pretend we're pitching the investment committee.
Okay, here we go. The outrageous but plausible trade idea here is go long AME and short a broader, maybe less differentiated industrial peer, perhaps using the XLI ETF as a proxy on a relative value basis.
Okay, so we're betting on AME outperforming the broader industrial sector, a widening valuation premium. What's the specific thesis behind that conviction?
We're betting squarely on AMETEK's operational leverage and, crucially, the successful re-rating of their segments, particularly EMG. The core idea is that getting Paragon Medical to those 35% plus EBITDA margins, that will structurally lift EMG. Market might start pricing EMG more like a high-growth medical device supplier, less like a standard industrial business. And that could allow AME stock to trade at a sustained premium compared to its more diversified industrial peers.
And the AI angle.
And yeah, that specific tangible exposure to the AI data center power build-out. That provides an underappreciated secular growth kicker that the market might be too slow to fully price in right now.
Okay, so to wrap it up then, AMETEK's Q3 really defined by exceptional execution, strong core margin expansion, those record orders, and a pretty meaningful hike to the full-year guidance. They seem to be juggling complex M&A while keeping that operational discipline top tier.
Yeah, I think this deep dive really underscored the strength and maybe the durability of their model, that consistent operate, innovate, acquire approach. The key takeaway, I think, for you, the listener, is just the sheer resilience you see in their differentiated tech portfolio. That's what lets them deliver, high-teen earnings growth, even when the macro picture is a bit shaky and others are struggling.
All right, so here's a final provocative thought for you to consider. Given all the global macro uncertainty, the competition for critical infrastructure, how much further can AMETEK really push organic growth in these niche markets like defense and AI power? And maybe more importantly, what kind of premium will the market ultimately give a company that proves it can hit, say, 35% EBITDA margins in newly acquired manufacturing businesses? That's definitely something worth watching very closely.
Absolutely. Thanks for joining us for this deep dive.
We'll see you next time.